Hi, I'm David Schneider, your trusted estate planning attorney, your trusted advisor. Today we're speaking with Della Starman of Watermark Life. Della is a long-term care insurance specialist. And Della, I want to understand more about what's in the marketplace. How do we look, or how do we shop for long-term care?
Yeah, basically currently we have 3 different types of products, and I'll just touch on those briefly. But the original long-term care that our grandparents had, we often refer to it as use it or lose it type of coverage. If you don't have a long-term care event, it just goes away. So kind of like if you don't have a car accident, you've paid for auto insurance for 10 years, but you never needed it. Long-term care, traditional, would be like that. We still have those offerings, but they're slightly better than what we saw in the past. The tricky part is the premiums are definitely more affordable, but they still have that use it or lose it. So if you pass before you have a long-term care event, you would have paid premiums for no reason. Secondly, the premiums are not guaranteed. In the industry, we are currently seeing 80 to 120% increases on some of our grandparents' policies.
Oh my gosh.
So across the board, well-established companies that have been there forever, because more people are using those policies. The cost to insure is much more higher for those insurance companies. So I do a lot of policy evaluations when the carrier pushes back and says, we'd like to reduce those benefits a little bit in order to keep your premium intact. We really want to make sure, do we want to reduce those benefits? It might be a really terrific policy. We call it a golden ticket with really great benefits. If you can afford it, a lot of times we don't want to touch it. We want to continue to move forward with that premium, still more affordable than trying to get insurance at this time of their life. The other types of products that are now available, we call hybrid or asset-based. And think of it as we're trying to purchase a pool of long-term care funds. We may take a policy and pay premiums to $100,000, $120,000. We might do it in a single lump sum, or we might do 5 annual payments, 10 annual payments. But it's not really about that base or that death benefit, because we roughly have that much as a death benefit. We are trying to gain a pool of long-term care funds for down the road. So it could be, even if you add inflation, you might see your 100,000 turn into 300,000 or $500,000. So if you bought it at 50, by the time you get to 82, it could be much, much larger, especially if there's inflation on the policy. So that's asset and hybrid. Some industry people call it one, some industry, but it's basically the same. The last product that we see in the marketplace is oftentimes for estate planning purposes, or where a grandparent might want to leave a legacy. So we see it as a permanent insurance death benefit focus. So our focus is having that death benefit no matter upfront. Okay, so day one, it's $500,000. But if we get down the road, and if we need it for long-term care and we put the rider on it, we can accelerate that death benefit and actually have 10,000, like 2% is usually the normal acceleration, but you could do more. And we'll see $10,000 coming back to the estate to use for long-term care on a monthly basis until all 500,000 has been depleted, dollar for dollar. And in the case where somebody may need care for 2 years and we see the policy death benefit depleted, but there's still money left over, they only use $200,000 for care, there'll be $300,000 coming back to the heirs, coming back to the estate for death benefit.
So many families are not going to be taken to the poorhouse, but the lack of the insurance is going to take them to the poorhouse.
Correct, because in care like for dementia and Alzheimer's, we are seeing, because they're in a facility sooner usually, and the care is actually better than independent living, sometimes they'll live even longer. So a dementia or Alzheimer's situation may go as long as 10 years. So I have a personal friend whose mother has been in care for 9 years
Gosh.
locally here in the state of California and in a very affluent community, and it's $14,000 a month minimum for care like that. So it will quickly deplete those kind of planning assets that were supposed to be set aside and handed down to the next generation.
You know, of course, we want to take care of our family. We want to make certain that they're comfortable, that they're well cared for. It's a lot of dough. Wow. We've been speaking with Della Starman of Watermark Life. She's a long-term care insurance specialist. Della, let everybody know how they can get to you, get this incredibly important information.
Hi, yes, I can be reached at Della, Della, at watermarklife.com, or you can also reach our website at watermarklife.com. Be happy to answer any questions.
And I'm David Schneider, your trusted estate planning attorney, your trusted advisor. Tune back in to see our next videos on helpful ways, things that you're going to need to know in your planning future.